Good afternoon, traders. This is Christian from Hertz Traffic Trade Group, and welcome to your end of day and end of week video. So let's get right to it. What a week it was. Risk disclaimer in front of you. Everything that we're going through is for information purposes only, not giving out any advice or recommendations. Please read the full risk disclaimer there. So I will try to talk fast. I know people have been asking me to do shorter videos, but this one's not going to be one of them, because I want to be kind of thorough and talk about what we experienced this week, what you can kind of take away from it, and how you can basically look to kind of counter for next week, and some of the things that I would be watching for next week. So first of all, one of the things I wanted to say is, if you made it through this week and you're still alive and kicking, give yourself a pat on the back. I mean, these markets have not exactly been the easiest markets to trade. I've been doing this for a long time. I traded, I was an institutional trader with Merrill Lynch back when the heavy risk time of 2007, 2008, 2009. So I certainly experienced, and it was in one of those seats as what's called a risk trader. I made markets for block trades for big institutions, right? Your biggest hedge funds and so forth. So I went through that time of some of the biggest volatility that we've seen in this market, and where there were bank failures and a lot of uncertainty out there. And then it got to be the time where you didn't know if your company was going to make it and if you were going to have a job, as the financial crisis progressed. So everybody, I think, who kind of traded through that time frame has that in the back of their mind, that because it was such an experience, like you're always going to come back to that experience because it was pretty awful. And there are some things that are from time to time, and some of them creep up more, that are going to say, hey, this seems very familiar to that, right? And there's some similarities to that time frame, and it's left a lot of scars for traders, because I think some traders think that and there's nothing wrong with this too, making this prediction that, geez, we're going to see that, right? For a while we saw a lot of people compare what the S&P chart from today to 2008, and saying that we were going lockstep and going the same way. Well, I mean, every one of these situations, these crises that we have on our hands, a lot of things rhyme, right? And you hear that when in trading, about history rhymes. It's not the exact same way, right? If you look at all the different financial crises that have happened, right, from 1929, 87, they're all different reasonings. There's all different circumstances, right? So the blueprint is not the same exact thing. Now, again, what you want to try to do, in my opinion, is try to identify some of the things where things really get bad. So regardless of what the unique circumstance is, you can find some of those similarities where things really don't look good in the market, and you kind of have a little bit of a roadmap to tell you, hey, I shouldn't be taking risk here. All right, so I'm going to try to go through that in this video. I'm going to go through, like I said, I've been doing this for so long that you sometimes you lose the muscle memory of when you do have volatility, but you kind of begin to like, if you've been doing this as long as I have, you do remember the things that you should be looking at, right, to kind of tell you if things are looking good, if things are looking bad, or if things are improving, or if they're getting worse. So I will go through that with you first, but I did want to just cover, like, of course, what happened today, right, with this bank collapsing. It's the biggest U.S. failure since 2000. Speaking of 2008, it's the biggest bank failure since 2008. So I was blown away by this, right? First of all, I didn't know that this bank was the 15th largest bank in the country. Really, so that was shocking to me. And look at this: Meta plans new job cuts again. How many times have we heard this the last couple of weeks? So that's number one that was surprising to me. And number two, the speed of which that this unfolded like this, and all of a sudden, they announced today, and that kind of is where I wanted to start with, just the market reaction today. If you look at what happened today, midday, and of course kind of going through today's price action, but the market was trying to actually recover, and some of the regional banks were actually trying to recover, until the news hit the tape that that basically the government is seizing the bank, right? And that scares, that really creates a lot of fear, because you begin to think like, okay, well, first of all, the stock's going to zero, and that means that, of course, the FDIC insures deposits up to 250,000, and I guess overall it's 500,000 including securities, but for just straight up cash balances it's 250. So you begin to, like, when you hear these types of things, and that means anybody who had more money there is going to either lose that money or have to try to get it back in some type of process. I don't know, so I won't speak to that, but that's really alarming, and it's unsettling, right? And yes, there's always the risk that that another shoe could fall off, right? And you're just not, like, in my opinion, there's no way to know how severe the problems are, right, until just we need more time to kind of go past. So one of the first things that I thought was important to kind of take a look at was, look at like some of their peers. Now, it's one thing that, and I talked a little bit about this in our midday video, so if you're a member, you could fast forward through parts of this because I've already talked about some of this. But number one, take a look at what some of the peers are doing, right? I mean, you had this First Republic down 15%, but also this Western Alliance, and again, I don't know any of the particulars. I don't know what these banks are holding, but the price action will tell you enough, right? If you follow option activity, right, and you're reading the tape, right, you could see in front of you, they're not hiding these transactions. You could see what puts they're buying in, right? So that kind of jumps off the page to you, like, okay, they're buying puts in this bank and in this bank and this bank, right? That there's a lot of other concerns out there. When you see people start buying calls, on the other side of it, which we did see a little bit today, right, until that official announcement came out. But so to see many of these banks down, well over 5%, some of them down well over 10%, right, tells you that people are fearing that this is not over with, right? You see Schwab in there too. They stick out like a sore thumb, right? They're down another 12%, right? And you don't know, it's too early to know, right, that if this is a buying opportunity or not, right? To see something like this go from 78 to 58, you don't know what these banks are holding. And again, that kind of goes back to what happened in the financial crisis, right? A lot of people didn't know how much paper of mortgage-backed securities and CDOs that people were holding, right? And one of those differences from there too was just the difference in leverage, right? All of those banks and financial institutions were so much more leveraged, right? They didn't have those, what we have now, which is the stress tests and so forth. Not to say that a bank can't go under, because we just saw it with this with this company, this SIVB, but the leverage is different, right? And again, that doesn't mean things can't go wrong, but it should be different, right? Because of that situation, right? And that parameter. But yeah, I mean, I think so. Number one, until these things kind of straighten out a little bit, right? That's one of the things that is alarming and tells me to not wade into this group. There's too many, right? There's too many other names that are falling like this. So that tells me, number one, that there's a lot of volatility, right? And number two, there may be some contagion, and it's just too early to know if something's going to happen over the weekend, right? And of course, traders don't want to, they don't want to hold a lot of risk over the weekend, right? So that was, so here's my quick checklist, right? Provided some areas to watch with the bank stuff, very technical term stuff, right? So watch what other banks are happening to other banks, right? That should tell you if there is some contagion, right? And also I would add in there option activity too, right? What about, let's go right, I mentioned volatility, so let's go right there, right? What's the VIX telling us, right? Well, this is what happened with the VIX today. We got all the way up to 28, 29. But you don't have a full green candle for the day. So I chalked that up. So number one, volatility went up. Number two, it didn't go up as much as we saw it last year. Look at the other spikes in the volatility throughout last year, right? The VIX actually got up to, in the 30s, right? So I don't think that you could say right now that volatility is just going to stop, right? Even though that's a pretty toppy looking candle, right? To see this big long wick on here. So this is actually a good sign. But do I think it's right away that you could see that volatility is coming out? No, you need a couple more days to see what happens with the VIX, because if something does happen over the weekend, this, it's just one candle, right? And one day is not a trend. So it's number one, it's too early, because if something does happen over the weekend, we could see the VIX shoot up to 30, right? But I think at very first glance of this, to see this kind of come in from a 28, right? You could look at other situations where you have had these very long wicks, right? Usually, like, here's a good example, right? After that, it moved down, right? And then some digestion, and then the volatility came all the way out, right? So again, you could go through example by example, but again, it's not 100%, but usually that means, that could mean that volatility might be coming in after that, right? What about the VVIX, right? Which also went ballistic today, right? Well, that still was up 18%. That's a huge percent. But it didn't close anywhere near where it was, right? So again, need more time for this. But overall, I think it's much better to see a candle like this than a full green bar, right? Again, take a look at some of these examples in the VVIX. Right. And if it's a full green bar, then usually, like you could tell, look at yesterday's candle in VVIX. It was a solid full green bar, right? And then of course you had the continuation. So it's just something that I pay attention to. But regardless, you could just go back to this VIX. Where are we? What's the overall level in the VIX? It's 2480. Right, so that's still much higher than where we were a week ago. It's something to be mindful of, right? So next on the list, right? Again, I'm just trying to give a little bit of a roadmap here. It's things that you can watch. What about the prices of the indices? Are they staying above the 200-day moving average? So why use the 200-day moving average? Well, in my opinion, it's just very simple. I like to have things that are less complicated so that I can make a decision, right? If it's super complicated, right, it's hard to make a clear-cut decision. But the 200-day moving average, right? If price is above the 200-day moving average, it's trending up. If it's below the 200-day moving average, it's trending down, right? And right now, we did sink back below the 200-day moving average, and that was yesterday, right? That we got back below the 200-day moving average. Again, very fast. How and if you didn't make every move correct this week, give yourself a break, because first of all, you're not going to trade perfect, right? So if you made some good trades, give yourself a pat on the back, but there's no way that you're going to be able to make every trade perfect, considering how fast and how whippy this market was. All right. So one other thing I would note too, well, a couple things really quick with this S&P chart. Obviously we got rejected at the bottom of value. So the valuers have really kind of give us some good signals. Remember back in here, so I guess I said 1 point, but maybe a few points here. Top of value is where the price got rejected. Right now, we also got rejected. We started the month below value. We rallied, like if I zoom in here, right up into the bottom of value. Again, this is using volume at price. This is our market webs Yeah. So this is our market webs indicator that looks at volume at price. So that was a rejection perfectly at the bottom of value. Now it's the question is this VPOC going to stand? Right. So I've put this out. I actually said it right in the beginning of the month. I thought that we were going down. Right. But of course, sometimes you don't go in a straight line, so we did bounce, get rejected. Right. And then we came down and took it out. Now, of course, I use multiple time frame analysis. Right. So did we take this 1 hour VPOC out too? Yes, we did. Okay. So there's nothing 100% certain here, but I would be watching this level come next week to see if it holds. Because if it doesn't hold, right, we've got another one behind it. Right. So let's say, you can even use this Venom line 30, which is an extension away from the March value area. So 38.57 is a pretty good level to watch. Right. And we did so far. Right. And again, it's very, very early, but so far we bounced off of that. Now, does that mean I want to be adding risk here? Well, no, we're still below the 200-day moving average, right? So again, price is very important. Price will tell you what you need to know. Let's go through just a couple of the other things that I like to, that are on my checklist, that I tend to watch when we have higher volatility. So let's just jump right to market breadth, and then we'll go through. I usually like to cover credit spreads last, but what is the market breadth telling you? Right, it's also confirming that things are nasty. Look at the left of my screen. Right, and I went over this yesterday, and I talked about how unfortunately, I didn't think that we were there yet in terms of the breadth. I thought it was very bad yesterday, but I didn't think it was extreme, right? If you listen to my video yesterday, right? And unfortunately, if it's not extreme, so here you are. I think this should have updated today. I guess that's just the level today. But yeah, so I mean, it's still very negative, right? This is down volume over up volume, right? So it gives just not straight, names that are advancing versus declining, but it's putting the volume associated with it, right? To give you kind of more of a sense of if things are doing things on light volume, or if things are doing on heavy volume. And today, again, you could see -7 for the NYSE. That is a very negative reading. So again, that means that there are more aggressive sellers than buyers right now. There's more distribution, right? And again, if you want to translate that even more, so again, this is just the breadth. Now, if you want to look at the straight up advancing versus declining, right? We know that this is also telling us that there's no doubt about it, right? This has been the trend now for a month, where we've seen more decliners versus advancers. So, these and the translation here is that the big institutions, they're not buying, they're selling, right? And that's going on right now in this market. And when we begin to see this line turn back up and maybe even cross over with the 10-day moving average, we know that the institutions are back in accumulating, but they're not ready to do that yet. All right. So breadth is a big thing, because it should confirm. And just like if we were right now we're going down, right? And what we would want to see is some type of divergence if we were going down, right? And we don't have a divergence yet. Everything is confirming. So if the price was going down and breadth was improving, then that would be like, aha, we're seeing something different, right? And on the other side too, if the market keeps rising, right, and breadth starts to deteriorate, right, that's a signal too. That's a divergence, right? But we're not seeing any divergences yet. So it's again it's a wait and see, right? I go back to my checklist, and I think the last thing that I have on here is what are credit spreads doing, right? Are they telling you that there's major risk right now? Well, they did move up pretty decently from the lows. This probably got too tight, right, in terms of what credit spreads were doing. So yes, when they move up, you hear people say like things like the credit spreads are widening, right? I wouldn't say that they're blowing out yet. That's when you really have a lot of risk, and again, this kind of may put things in perspective for you. I had someone, and I apologize because I didn't respond to somebody on Twitter, but does this mean that things are going back up here? It's too early to tell that. right? It's certainly I think you just want to, instead of looking at a pattern, you want to look at the overall level, right? The overall level is not extreme yet. So even though we have this big situation with the bank, you're not seeing credit spreads. So that's one thing, right? That is somewhat positive, I would say, for the overall market dynamics. But regardless, the other things that I've mentioned so far, I think give you enough of a feel to say, hey, prices below the 200-day moving average. There's still a lot of banks that are going down versus going up, right? And the breath is horrible, right? The VIX looked a little bit toppy today on those candles, but you need more evidence, right? And once you kind of have some of those things go the other way, and it doesn't have to be every single one of them on the checklist, but when you have 5 things and 4 of them are bad, right, that gives you a sense of whether or not you want to be taking risk, right? So for me, it means don't take much risk. The conclusion is don't take much risk, and then you just kind of have to wait, right, and be prepared for things to improve and be patient, and they will. They always do. It's a matter of time. Could be a couple days, could be a couple weeks, it could be even longer than that. But you stand ready for those conditions to improve. All right. A couple other things, I've talked a lot about, of course, like how this is affecting what the Fed might be doing, right? So this did knock back down to about 33 basis points. So we don't know what we're going to get in terms of this 322 meeting. We don't know if we're going to get 25 basis points, or we don't know if we're going to get 50. It did move back to the side of 25, but it's not all the way there. And of course, next week, why wouldn't it move all the way there, right? Well, we've got some big data this week that's coming up, right? Which is the CPI and the PPI report, right? Those are big things. So, of course, it's not going to go all the way to one of those because this should be affecting things. By the way, I didn't even cover, you forgot, with all these things going on, I forgot that we had a jobs report this morning. Look, the major thing that I think, some people get so occupied with what financial media wants you to kind of take away from this when they're looking at the non-farm payrolls or the private payrolls right now, and it could change, but this is the most important thing: the average hourly earnings. Why is that the most important thing right now? Because inflation is such a concern, right? The Fed is trying to bring down inflation, right? Now, it would be great too. I mean, it will come down faster if the overall number is weaker. But I put this scenario out early, and I'm sorry, I'll be quick with this. But would you have rather had a report today that came out with only a change in non-farm payrolls of say 100,000, but this average hourly earning number came out at 0.5? What do you think the market would have done right away if this average hourly earnings number came out at 0.5, but this was 100,000, right? The market probably would have tanked right off the bat. Why? Because that means inflation is still sizzling hot, right? So the fact that this came down, even though it's only a tick, right, is at least showing that there's some there's some progress here, right? And I think that's much better than oh geez, oh no, the jobs number came in a high 100,000 more than expected, right? It's really about if the wages are coming down, because that is what the Fed is that's why the Fed is raising interest rates, right? Is because of inflation. All right. So again, I told you this video would be a little bit longer. It's the end of the week video. I just wanted to kind of give you a sense of this too, right? If you look at the 30-day for this, or 1 month, right? Just to give you a sense of what transpired this week. Basically, for the last week or so, Fed fund futures for March were only implying about 30. It was going back from like 29 to 30, 31, right? And then this big move happened. So we're not back to where we were on Monday, but we're much closer to where we were. Another thing that I looked at too, right? So when I look at this, right, I always look at the upcoming month, right, and what it's expecting, what the implied rate is expecting. And then I also look at the path after that. So July has always been, or has been for the last couple of months, where the peak of the rate of what the Fed is doing. It's been around July, right? But look at what happened here when you look at the 1 month for this, right? So all in, right? The rate looked like it was coming up to about 5.6, right? Notice how far down this moved, right? And if you want to just look at so that's, the rate all in. If you want to just look at the change, right, then you could look at this. You click on this and you bring up 1 month. Right. So this is what's left, what else the Fed is doing from now until July. Right. And the market was pricing in 110 basis points. Well, now we're all the way down to 70. All right. So this, what transpired today and yesterday has brought the Fed fund futures down to indicate that they're not going to be raising rates as aggressively. Still 70 basis points is what the market is pricing in. It's a little bit better than 110. So again, just wanted to show you a couple things that I noticed. That's basically it. I think that's enough to cover. Again, the performance, I didn't even show the performance for the week because there's so much going. Usually I go right to the performance for the week, but SPY fell 4.5% for the week. IWM, which again, the banks are the biggest weight in IWM. They're about an 8% weight, right? So that contributed to IWM falling 8%. The Qs actually outperformed. Pretty, interesting there that the Qs continue to outperform on a regular basis, on a relative basis. My eyes are already going to the right of the screen. Regional banks fell 16%. The metals and mining, after having that big week last week, I think they gave it all back, didn't they? I think they were up like about I'm forgetting how much it was, but we could go through a couple of these sector charts really, really quickly here. But that's really ugly. Yeah, I mean, look at the candle last week and look at the candle this week. That's what we call nasty. The other one that stood out to me was what happened to XBI today, right? To the biotech. I mean, that's been holding in there, and we even saw some bullish call positioning in here, but this thing broke really decently. And again, why did that do that today? One of the things that I heard was that some small cap banks may have some small cap biotech, may get their funding from some of these smaller banks. So that kind of threw this group out of whack. I mean, I don't know if that's all the reason for what happened the last 2 days, but that's a nasty move. That's a nasty risk off move. So when you break it down by sectors too, right, and see something like this happening in biotech, that doesn't give you a warm and fuzzy feeling about risk. Okay. And let's just see if there's anything else that I wanted to cover with the weekly numbers. The semis are going to be something to watch too, right? They were actually holding up very well up until I think yesterday, right? And they kind of moved. They moved in. So again, one of the things that whenever we have some type of bout of volatility is let the dust settle, let things improve first, let buyers step back in, right? Especially the institutions, see it in the breadth, see it in the price action, and then notice what groups will be, leading and moving higher. Right, because a lot of things like the XME, like even I've been touting how well the industrials have been doing. Right, they really got hit hard too. I've been touting how well this the infrastructure has been doing. Look at the price action the last couple of days. It just kind of shows you that you can't get complacent, even in something that's been acting so well, right? When they come for this stuff, they don't leave any of the things, right? Sometimes you hear this phrase all the time that says like the market generals are the last to go, right? Well, in years past, the market generals used to be, right, the FANG stocks. Well, they haven't shown any leadership for over a year. What's been showing leadership are things like the industrials, recently. So they got hit today. There'll be a lot of analysis that we're going to be doing next week. I'm excited for next week because finally we get the CPI out of the way. And then, I've toned down, I'm not wearing any risk right now in my trading account, right? And sometimes that can really help, right, in terms of analyzing the market and being ready for what comes next, because you're not exposed and you're not stressed out about what you have on, right? You're nimble and you're ready to go. And that's kind of, I always like to kind of show, I give the perspective of what I did for the day, right? And you could see, I had to unwind a couple positions, right? That's not fun. But once you kind of get over that, that happens all the time, in a cycle of, a correction, right? It's not really that big of a deal that you have to get out of a couple names, get out of one name, probably for a bigger loss because it actually flashed the stop price on it yesterday and I kind of ignored it and I had to take it off today. So that was a bad decision. Going to make some bad decisions every once in a while. But I also had a number of really good trades today too, right? I caught this, I took the bounce that we saw in the jobs number and I sold into it, right? I bought this, this TZA before the market opened. I think this was at, sorry, right in here. This is at 9 o'clock this morning, right? So I took the bounce that we saw and I added this, right? And this was a pretty nice winner for me. I got to take this thing off around 32.90. Then I wanted to see what the market did. It looked like we had a bounce going. I actually flipped and went long IWM through the TNA ETF. And I made a little bit of money in that. Again, I once I saw that it was starting to fade, I took it off pretty quickly, right? And then really didn't do much for the rest of the day, right? I took off a couple other names, and went from there. I would have liked to keep this PBF trade on because we keep seeing option activity, and I hope nothing happens with that name over the weekend. So they've seen bullish option activity about 5 times over the last couple of weeks. I think something's up with that name. No idea what, but we keep seeing aggressive option activity in it. All right, guys, that's it. Have a great weekend, everybody. Final thing is, if you like this commentary, obviously some of what I'm going over in this video is a little bit stale because I've gone over most of this like pre-market, right? We do a pre-market session every day at 9 o'clock, but you have to be a member. Sign up, give it a try. And, of course, give me your feedback too, because I think, what we try to do is we really try to add value, especially to people who haven't experienced this, right? This type of thing is not easy the first couple go around. So I really try to prepare traders, get them on the right side of the market. Have a great night, everybody. Again, that's TribecaTradeGroup.com. Please like the video as well. Thanks. Have a great weekend, everybody.